concept to commercial opportunity. Thanks so much for the National FinTech Organization for putting this panel together. And thank you all for spending your lunch with us. So 2 quick notes before we get started. As mentioned, please drop your questions in the chat as we go. We're going to try our best to reserve some time at the end for the Q&A. Remember, this is educational. It's not legal, tax, investment advice. So before we get started, we'll do some quick intros. Myself, I'm Rusty Planert. I'm a senior manager at Wipfli, based out of the Chicago office. I work primarily with financial services companies on the audit side. And since coming to Wipfli in 2019, I've served as the subject matter expert for anything touching digital assets, includes working with fintechs, financial statement audits, stock audits, that sort of thing. Now I'll kick it over to the panelists to introduce themselves. Let's go ahead and start with Angela.
Thank you. Thanks, Rusty. And thanks so much to NFO for having us. I'm Angela Brasington, a Web3 ecosystem builder with 10 years in crypto and blockchain. And I'm currently leading the US expansion at TON Foundation, where I drive growth and partnerships and developer and community adoption across TON's entire ecosystem. Prior to that, I worked as CMO for a DeFi launchpad, helping launch and grow products through multiple market cycles, and as chief of ecosystem for a Web3 operating system where my focus was on scaling builders and real-world use cases. I'm thrilled to join this great panel today and talk about how stablecoins are moving from concept to a real commercial opportunity, finally.
Awesome. Now let's kick it over to Jason.
All right. Thanks, Rusty. Thanks, NFO. Good morning or good day, everyone, depending upon where you're calling in from. I'm Jason Ruyle, VP of Market Strategy and Innovation for DCI. DCI is a core processor based in Hutchinson, Kansas. We process for about 170 banks, give or take, ranging in asset size from de novo on the small end all the way up to about 5 billion on the upper end. We are, full service core, card, digital offering vendor, and got banks in 32 states, 33 states, I believe. I'm a former community banker. I always, joke around. I know we've heard this term from a lot of different people, recovering community banker. My primary role at DCI is in corporate strategy. So amongst some of the other areas, I cover third-party strategic relationships, vendor management, our project management office. I also kind of spearhead all of our fintech sales initiatives. So today I'm representing kind of the community banking perspective on stablecoin. So appreciate the opportunity.
Thanks for that, Jason. And then let's kick it over to Nick.
Well, thanks, Rusty. It's a pleasure to be here. I'm Nick Elledge, co-founder of Stablecore. So we sit alongside traditional cores and digital banking front-end technology to allow community banks, credit unions, and all the way up to super regional banks to be able to offer digital asset products. That spans the gamut from payments, including stablecoin and tokenized deposit payments, having digital asset accounts and trading that look more like Robinhood or Coinbase, all the way to being able to use digital assets, which are a $3 trillion asset class, as collateral for lending. I started my career 15 years ago at McKinsey & Company, and I worked on 5 different continents. So I had a lot of international experience. That's actually how I first found out about digital assets, was they were trying to do payments and cross-border with Bitcoin, and I'm trying to experiment. So it has solved a real problem, or people have been trying to solve real problems for a while. And as Angela said, it's exciting to see real infrastructure use cases starting to emerge.
Very cool. Thank you for those intros, folks. So before we jump into the panel, we want to give a little bit of a quick context on Genius. I know we're going to have a wide-ranging understanding of Genius and stablecoins in general here for attendees. So we'll give a little bit of a level set, so to speak. So the Genius Act passed the Senate in June and the House in July, overwhelming bipartisan support. Everybody expects the sort of go live effective date for Genius to be January 18th, 2027. So a little under a year to go to get ready for that go live. So when most people hear crypto, digital assets, they think about volatility. Payment stablecoins are designed to remove that volatility. The goal is a digital dollar, not a price bouncing asset. The unlock here is that stablecoins exist on a blockchain or distributed ledger, which means the movement of value can settle in near real time, 24/7, virtually for free, with fewer batch windows and intermediary layers we're used to in legacy payment rails. Under Genius, the model is explicitly boring by design. These are really just meant to be one-to-one backed, high quality reserve, liquid reserves. A payment stablecoin is basically a digital asset meant for payment or settlement, where the issuer is obligated to redeem it for a fixed amount of money. Think $1 in, $1 out. Easiest mental model, digital cash with a better delivery mechanism, programmability built in. Also think about it as a tokenized government money market fund. Genius is very specific about what can sit in the reserves. It's designed to look like cash, very short duration government instruments, bank deposits, US Treasury bills with a duration of 93 days or less, or overnight repos fully secured by treasuries meeting those rules. And that's really the point here. Duration risk is intentionally capped. Reserves are boring and cash-like. This is the stuff that didn't fail in 2008, 2009. It's designed to be safe. Really, the only way these fail is if the US Treasury itself defaults. So think as safe as can be. Our critical consumer protection here is that the reserves can't be pledged or rehypothecated. The intent is really simple. Nobody is doing something with your money. They're there to support the redemptions, and that's it. Genius is built around those clear redemption expectations, also addresses what happened if an issuer fails. In insolvency, the stablecoin holders have priority over everyone. Under Genius, there's also transparency. Issuers have to publish monthly reserve compositions on their website, including outstanding coins, a reserve breakdown, average tenor, and custody location by category. Then a registered public accounting firm has to come in and examine those monthly reports. The CEO and the CFO testify, assert to those attestations being accurate. And if they're false, they're triggering criminal penalties. So there's that real executive accountability. And then lastly, issuers have a financial statement audit by a registered public accounting firm on an annual basis. One other nuance is the interest component. We talk about the yield piece of this. Genius prohibits issuer from paying holders any form of interest or yield solely for holding the payment stablecoin. That actually makes sense when you think about it. It prevents the narrow bank, which simply would not function in our current financial system. But it doesn't mean no yield anywhere. In practice, fintechs, banks, fintechs are likely not going to become stablecoin issuers. They can partner with regulated issuers and still offer interest-like experiences through separate products, rewards for performing a certain number of transactions, things like that. I will, pause here for a second. Some of this is being negotiated in the market structure bill, but we're going to operate under Genius for the purposes of this panel. But I will acknowledge that there's been some of that discussed in the markups for the market structure bill currently ongoing. Genius explicitly treats permitted payment stablecoin issuers as financial institutions for the purposes of the Bank Secrecy Act. This means real expectations around AML, KYC, sanctions compliance, customer ID, due diligence, suspicious activity monitoring. And because stablecoins move on blockchains, there's a transparency dynamic to this. Transaction data is recorded on a distributed ledger, and the Genius Act contemplates standards and guidance around monitoring transactions and blockchains. We'll get to that in the next question. Finally, Genius requires issuers to have technological capability to freeze and seize, burn, or prevent transfer of the stablecoin. So this isn't, this is a regulated compliance perimeter. This is not Wild West product that we're talking about here. Genius is also trying to avoid sort of closed loop money systems. So who can issue a Genius compliant stablecoin? Well, you have to be a public company that's predominantly engaged in financial activity. So we're not going to have, an Amazon coin, a Walmart coin, that sort of thing, creating walled garden currency at scale. And then regarding supervision, Genius keeps familiar lanes. We're talking OCC, NCUA, regulators that we trust. And federally licensed non-bank stablecoin issuers are licensed and supervised by the OCC. So regulators that we know. On the last level set, this is not a brand new concept with no precedent. They've been doing this in New York Department of Financial Services going back to 2018 with no failures. And it's pretty clear that Genius is meant to mirror that playbook because it works. Okay, so that's the level set. I hope that was helpful for folks. Now we're going to get started with the conversation. First question for the panelists. Maybe we'll kick it off with Angela. Angela, what parts of Genius are clear now, and what's still going to be defined in rulemaking?
Yeah, on a high level, what's clear is the direction. As Rusty said, the Genius Act creates a federal framework, right? And that's specifically for payment stablecoins with one-to-one identifiable reserves, strong disclosure requirements, like you said, and explicit limits on rehypothecation of reserves. Importantly, Genius is not theoretical anymore, it's law. So what's unfolding now is the work of turning that law into regulatory infrastructure through rulemaking this year. And I think that's where the rubber really meets the road for market participants. The parts that will really matter in practice and that are still being defined are the operational details. Things like how regulators standardize examinations, how approvals work across different issuer types, how ongoing supervision scales based on size and complexity, right? That's where we'll see how this framework actually functions in the real world, in my opinion.
Sure. Devil's in the details there, huh? Anybody else want to chime in?
I think just one clarification is that a lot of banks aren't waiting 12 months, just in case that's not clear. I mean, a number of banks have already gone live with stablecoin payments or digital asset accounts. Certainly, we're aware of dozens of others that are building with us or trying to build by themselves to launch those capabilities. So definitely I don't think folks are waiting for the rulemaking period to be done to begin investing in the infrastructure today. And they know that they may need to make a slight tweak here or there after the rulemaking period's done. But I think most legal divisions have said, yeah, it's clear enough for us to go ahead and build these capabilities.
Yeah, and I mean that's well said, Nick. I think Genius passing made it clear that this is here, this is coming, this is now, and so that is that clarity that folks needed to really dip their toe in the water, so to speak. So thank you for that. So when clients say we want stablecoins, what do they usually mean? Are they talking about faster settlement, cross border? What are we looking at, guys?
I'll jump in here. Most don't want stablecoins as a buzzword, right? They want real outcomes. They want faster settlement. They want 24/7 movement of dollars, better cross-border economics, and increasingly programmability for things like automated payouts, escrow-like flows, or treasury ops. The best conversations get specific fast, like you just said, Rusty. Which user, which corridor, which flow, what compliance perimeter. I think that's where stablecoins really go from interesting to ROI, and we like ROI.
Well said.
Yeah, I think to chase a topic du jour, a lot of our customers and just the community banking segment in general were very shaken with the fallout from SVB. And it was an all-out war, and it still is somewhat, to keep commercial deposits local, right? And so I think from what we've heard from our customers' feedback is, they don't want to be worried about, the big money centers going after those commercial clients. And they have to have treasury services. They have to have cash management services that are on par with what the big banks are going to offer. So again, it's kind of the economic treadmill. You're going to jump on or you're going to get left behind.
Well said. Customers want this.
Yeah, just to echo those 2 points, I think some of the use cases that are driving it are coming from early customer demand. So a lot of these sponsor banks who sponsor fintechs have been some of the first adopters. We've seen Cross River and Lead Bank and others building and launching stablecoins very early in the space in order to support fintechs. We see a lot of cross-border, so treasury management. This just kind of being table stakes. We have wires, we have ACH, and now people are asking me to send money to a wallet, and I don't know how to do that. So you can either have a wire transfer out to Coinbase or somewhere else, and then you lose the deposits and the relationship, or you have the capabilities in-house, and that's, I think, driving at least the stablecoin conversation at a lot of banks.
Well said.
Also, in filtering out some of that noise, Rusty, right after Genius passed, I believe it was the Wall Street Journal that, ran an article, and there was all these prognostications about how much deposit base was at risk, right? I think 4 trillion was kind of one of the numbers that I heard. And really, that's just the overreaction from the noise. As banks have had a little bit more time, about 6 months, to kind of settle down with this, we've had a lot of conversations of, you've got to, again, adopt the technology that your customers are expecting to have. But that type of fear, clearly, we don't see it for the normal consumer use case. So as Nick just said, treasury management, cross-border, 24/7 payments. That's the other piece of this. I think that is really the interesting thing because, in the community banking segment, we've been bound by this whole notion that money sleeps, and that's gone. Like you don't have bankers' hours that dictate the guidelines of when you're going to do a home loan close. The title company can't wire money because the bank's not open. So all these things kind of get disrupted right now, and the whole notion of float will eventually disappear. But as far as the products and uses are concerned, I think obviously commercial settlement, cross-border. The other thing that we've seen or heard from or I've read about is the gig economy. It's really big for those workers who are expecting basically per job or same-day settlement for work that they've done.
Great stuff. Great stuff. I mean, to that end, where would you say stablecoins are delivering real value today? What kind of user? Are we talking consumers, enterprise treasury operations, or all the above?
All the above, probably. I think stablecoins win when they're embedded into a product flow, not when users are forced to learn crypto. And a lot of what was just said by Nick and Jason, like the cross borders, we're seeing companies like MoneyGram and partners in Ripple's ecosystem use stablecoins and blockchain rails. Then also thinking about small and medium businesses and marketplaces, platforms like Stripe and Shopify are experimenting with stablecoin payouts through partners. It goes back to what Jason said about just 24/7 movement of money. All of these things. Also on the treasury side, actually, enterprise treasury side, firms like Circle and institutional clients are using platforms like Fireblocks, right? They rely on USDC for that 24/7 treasury management and intraday liquidity and many other things. So I think across all of these use cases, the pattern is the same. When stablecoins are invisible, and we talk about this all of the time in the industry, but when it's invisible to the end user, that's when adoption can skyrocket. When people don't have to think about wallets and gas fees or blockchains or which blockchain, they just see faster money. That's when it really works.
Yeah, sort of that stuff gets obfuscated away a little bit. When the UI works, it just works.
Yeah, it's invisible.
Very cool.
I'm not sure if we're going to see folks filling up gas in their truck with stable coins anytime soon in the US, just because US dollars work pretty well in the US. So it's useful to divide it between consumer and business or enterprise use cases. So on the consumer side, stable coins made kind of the evolutionary leap. That's how we think about it, that these things have survived in the wild and grown to multi-trillions of payments. How did that evolution happen that they became so popular? Well, they went from crypto trading and hedge funds, kind of made the evolutionary leap out to a lot of developing countries and emerging markets. And that solved a real problem for being able to store value and be able to make payments in a steady currency. And now they're kind of coming back in post-Genius Act into the US. And so we are exploring what are those use cases, but I think a lot of it's going to be B2B. So we know that Visa and MasterCard have been very aggressive in stablecoin. Stripe has been very aggressive as well. And we see JP Morgan leaning in very heavily. So a lot of big institutions that can figure out the complexity, have a lot of software engineers, and are trying to optimize their operations and provide seamless experiences, as Angela said. Seems like the flavor of stablecoins that we'll probably see first, because we do get that question a lot. Is adoption going to be more in consumer or in enterprise? And I think that you see on the consumer side a lot more kind of speculative crypto trading, buying Bitcoin, et cetera. And on the commercial and the payment side, it is kind of just down to business.
Well said. Well said. Yeah. And, U.S. consumers, the U.S. dollar is, it just works like you said, Nick. But, there's a lot of folks in other countries that, with Genius, they're going to, you have something of value and access to the internet. You now have access to the U.S. dollar, and that's great for human rights. Love to see it. So if you're building with stablecoins, what's the smartest rail strategy? Jason, you said it well in prep. Don't bet on a chain, partner with an aggregator. What does that mean in practice?
Yeah, again, this is the lens through the community bank, right? Or even mid-tier. I think that it's best to leave that up to the large mentors or issuers because look, this is a very disruptive technology, and things move at lightning speed. And one thing that is not lightning speed are banks. You staged it well, Rusty. I think you said boring, or when you're defining genius. Banks are boring by design. They're a product of the regulatory framework that they operate within. And again, that's not good or bad. That's just to ensure safety and soundness of the system. That's who we are, right? So I think that if a bank's going to jump into this, they shouldn't be looking at one particular, whether that's Circle or Tether. They really need to be looking from a broker perspective, because again, you don't know who the big market players are ultimately going to be, and what's true today may be completely turned on its ear, 12 months from now, maybe a flip of who the large scale issuer is. So by and large, we've advised, hey, you don't want to be looking at partnering with one particular company. It should be, again, like an aggregator, much like to what Nick's company does. So
there you go.
And that's just part of the risk calculation. Jason, you mentioned Silicon Valley Bank. Risk, it appears in many different forms. And one is, picking a horse and saying, hey, this is all that we're going to be tied to. I think any bank that is looking to play in stable coins is not just looking to say, hey, we only want to support one stable coin. They do want the layer to be able to say, hey, anything that our customers want to use, we want to be an on or off ramp for that, and to be able to work with it so that we don't get into a situation where, there are a lot of companies that, were around in 2022, but now are part of the fossil record, and you don't want to tie your horse to one of those. So it's just smart risk mitigation.
Smart. Well said, guys. Angela, you had a great line in prep. Fintech should treat stable coins like early startups treat APIs, and winning UX hides blockchain complexity. Can you walk us through what that looks like in a fintech product?
Yeah, exactly. So I said that fintech should treat stablecoin rails the way early startups treated APIs. And what I mean by that is it's powerful infrastructure that totally disappears behind the UX. It lives behind the scenes, actually. So that means no wallet education is required for mainstream users. And that's a big one. That's a big one, because wallets are clunky and we have to store things and we have to remember things. And it's not ideal for mass adoption. It also means there are no confusing gas fees popping up as a surprise line item, confusing people even more. And then simple identifiers like a phone number, an email, or a handle instead of a very long alphanumeric address would be supportive as well. I think clear and instant feedback, like simple things like sent, received, available, funds available, things like that. And all of the compliance and risk checks just happen quietly in the background. And at the end of the day, the product should feel like modern payments. Stablecoins are not the product. They're just the plumbing, is how I like to think about it.
Stuff that just works. That's what the customers want. Yeah.
And what they're used to.
Yeah.
Just to echo that, I think that would be a really useful initiative, just putting this out into the universe. We've said it before for American Bankers Association, to take on, to map all of those addresses and simplify them so that it can be as easy as a routing number.
Well said. So where do fintechs, banks buy versus build? Specifically, I'm really interested in custody, safekeeping. What do you think should be outsourced versus owned?
Well, that's pretty much front and center to a lot of what I do when new tech emerges or we see new services. Build, buy, partner, right? That's the three fork road. Again, from the community bank perspective, we're squarely on the partner front edge of that, only because this is, again, very it's highly technical, it's new, it's changing at rapid pace. We need people who are in it and live in it. We've talked, we've got payment rails, the traditional rails on our back end, ACH, real-time payments fed now, debit card rails. This is something that's highly in flux right now. So we've very much taken the approach that it has to be done through partnership.
I feel like that's smart for most teams to buy or partner first, then selectively build once volume and regulatory posture really justify it, right?
How about you, Nick?
Good.
We see that a lot on the custody side, that there are a number of sizable banks that are saying, we'd like to build our own custody, but we know that it is a huge lift and a multi-year journey. So we're going to get started working with one of the leading sub-custodians like Coinbase, Anchorage, Fireblocks, BitGo, etc. And we'd like to embark on this multi-year journey alongside that. So that's one area where there's a clear kind of we're immediately going to partner, but in the long term, we want to be able to build, I think, an area where it's going to be tough for especially individual institutions to build is issuance, issuing your own stablecoin. There are just so many network effects that have to be involved unless you have really a lot of distribution and a lot of volume. The economics of those network effects don't make sense. I mean, the 90+% of all stablecoins today are Tether and Circle, and we will see individual corridors that are owned by organizations like Western Union, for example, where they'll have more of a B2B style stablecoin. But especially if you want something that's going to have kind of mass adoption, we would recommend not going it alone and trying to do it in some sort of consortium, or just saying we're just going to support the rails generally, because that's an area where even if you have the ability to build it, it maybe takes a week to launch a stable coin and do the press release, but you'll spend the next several years asking folks to accept it. It's just a large acceptance and network effects problem, almost akin to saying, I'm going to start my own Fed now, something like that. It really is a massive lift.
Yeah, good luck with that. Yeah, no, I think those answers make sense, guys. It's we haven't really had regulatory clarity here, and so it's been difficult for institutions I think we would normally trust for this sort of thing, like a well-regulated bank, to dive in. They just don't have the talent currently on their staff to build something like this out. So relying on custodians that have been doing this stuff for literal years and are considered experts in the space, I think that makes a lot of sense. So, as we talked about, compliance is really still a very important aspect to this. AML, KYC, BSA, the travel rule, all those apply, but now we're talking on chain. You see more than one hop, and there might be some flagged addresses that are out there, because there's companies that have been sort of, tagging these addresses for literal years. For a fintech just getting into this, what's table stakes before launch?
From a fintech, especially if there's a sponsor bank on the back end that they're partnering with, they absolutely have to get BSA, KYC, AML all figured out ahead of time, because just due to the finality of the network. I mean, payments are, all the other mechanisms have some recourse, wires, Swift, through the multi-hop, custodian in the process. There's always a chance that if it's fraud, you can jump in and stop it. That's I guess the major risk that banks are going to be grappling with, is the finality around stablecoin transactions are done. So you better get it right on the front end, and really start thinking hard about the KYC piece of this.
Really important. Well said there. I also think about policies and technical controls to block or freeze or reject impermissible transactions when required. I think that's really important there. I think the key mindset shift here is on-chain often gives you more observability than traditional rails. So the bar becomes, can you operationalize what you can see?
Yeah, that transparency, it's great, but it does add a little bit of a burden there. What are you going to do about it?
Yeah. As you were saying, Rusty, there are great tools out there. So calling out to Chainalysis and TRM Labs, they do a lot of on-chain analytics, and I think the challenge for a financial institution, so that sponsor bank or a bank that's doing this, is once we have that information, what actions do we take? So to give you an example, we were just talking to a bank last week, and their chief risk officer said he didn't know the term hops, but he was referring to hops to, what if it goes to someone and then goes to someone and then it goes to North Korea? Am I on the hook for that it went around, and then how far do I have to be separated from that transaction for it to be legit? And these are the types of thorny questions that I think all chief risk officers and chief compliance officers are dealing with right now, and it's probably one of the slowest moving parts of this is just getting comfortable and understanding, how do we update all of our, not all of, but a significant amount of our policies? How do we do a risk assessment on these new stablecoin capabilities? Because as you said, the finality is there, which is a feature that it can move quickly, but it's not reversible.
Thanks for that, folks. Well said. Yeah, so that AML KYC, like clearly something where you've got to be wrapping your head around it. Chief risk officer is obviously dealing with some difficult questions, but the sooner you wrap your head around those and start dealing with that, the better off you're going to be resolving these issues for your customers. So let's talk about the risk of doing nothing. If stablecoin powered dollars become sort of the default like table stakes for the next generation, instant 24/7 global and app native, what happens to fintechs and banks that don't adapt or integrate this tech over the next, let's say, 12 to 24 months?
I think from backing it up a little bit and talking about it from a policy perspective, and I'm not trying to get political, hard to talk policy without getting into the politics of it, but from a policy perspective, it's actually not bad legislation from my perspective. I mean, it's all about financial incentives. What are their financial rewards? And the best policy that we could put out there is something that's going to provide a gain, but not force an action, right? So Check 21 is probably the best example of that. After 9/11, being able to exchange images of checks. Obviously, not every bank had the technology, but they clearly understood if they didn't adopt it, they didn't make a CapEx, they're going to be behind. And I think this is written very similarly. Like you don't have to adopt this, but what's at stake is probably your commercial customer base.
Seems important.
Yeah.
Angela, Nick, anything you want to add there?
Yeah, I think I would add that they risk losing product relevance to platforms that offer that experience natively. And also just getting pushed down the stack into slower, low margin utility roles. So I really recommend if you don't ship a full product, having a measured integration strategy is really becoming a competitive necessity.
The way that it plays out in practice, I think, is that it takes one commercial customer who says, hey, somebody asked me to pay them in stable coins. Do you have that at the bank? You say no, and they need to make that payment. And then they go and set up an account and a relationship somewhere else and move deposits over there and set up a new account and relationship. That may not sound detrimental at first, but that's a foot in the door for other products and services and looking more and more like a bank from that other service provider, which has been the playbook so far to create some really, really big companies that have siphoned a lot of deposits out of the traditional banking system. So I think that's the risk is you can debate, well, by 2028 or 2030, is it going to be 1.5 trillion of stable coins or 3 trillion? But it really just takes one payment being needed and then having to figure out a solution to make that payment. And then if your bank or your primary financial relationship doesn't have it, you do have to go elsewhere in order to set up that account. So I think that's how we'll see it play out. And that's kind of the opportunity cost of missing out, is that you are giving up that relationship. And you might not see a large outflow at first from that, but it, like I said, it does give a foot in the door for you to lose account primacy over the long term.
So, pretty clearly, this is a priority for folks. Put yourself in the shoes of a fintech or a bank. Let's say you had 90 days to get stablecoin ready. What are you doing first? What are you focusing on?
You call your core provider, because ultimately you still want that experience to live in your digital. So you have core or digital provider. The sworn enemy of payments is friction, right? And that's to Nick's point about, consumer adoption, why you wouldn't be using, stable coin to pay for your big gulp at 7-Eleven. But So I think just the friction alone is really the concern.
How about Angela, Nick? What are you doing first? 90 days to get ready.
I've seen it play out on different ends of the spectrum, and obviously I'm biased and would say, please get a demo of Stablecore if you're in that situation. But the bigger super regional banks, they just talk to all of the stablecoin issuers, crypto custodians. They kind of do a round robin tour, meet everyone, get proposals, try to figure out their strategy. And that's what they do or have been doing throughout to figure out how they're going to launch these capabilities. I think if you're more in the community banking side, you want something that's going to come from your core, your digital bank provider, or at least is going to be fully compatible with those. And so, Stablecore integrates into those. I know the cores are developing these capabilities, are going to be launching them at some point in the future. We haven't seen that yet, but we know that Fiserv has had press releases about it. FIS has had press releases. Jack Henry talks about it on their earnings calls. So clear that there's going to be some sort of capability that comes out around that. So just being thoughtful and comparing your options and saying, okay, what is the cost? What is the workflow? As Jason was saying, is ultimately is these technologies move from impossible, which is where it was at 9 months ago, to trivial, which is where it will be headed in about 6 months.
Well said. Yes, I mean, it sounds like if someone wants to take this seriously, you're having a lot of conversations. You're obviously talking to your core provider, but you're probably talking to a lot of other providers as well about the best way to get stable coins in your system. And those are conversations that take time. As we've talked about over the course of this panel, there's a lot of questions that come up that those answers aren't necessarily easy that people are going to have to resolve. And the sooner you start having these conversations, dealing with these difficult questions, the better off you're going to be. And it's just going to work. And so, we have some time here for some questions from the audience. I wanted to give an opportunity for folks to ask of the panelists. While we wait for those questions to come in, another question for the panelists here. What do you think will matter more in 2026? Are we talking UX differentiation, or are we talking compliance and partner readiness?
I was reading the question from Chris Wilson. I apologize, Rusty. Maybe you need to repeat that one for me.
Yeah, absolutely. So, question on where to focus your time in 2026 if you're doing something here. What do you think will matter more? UX differentiation, where stuff is just working, or compliance and partner readiness? What's more important to focus on?
I mean, as far as the banks we're working with, we are working across the board. So it is UI and embedding it into corporate treasury workflows, making that seamless, embedding it into the digital banking front end experience, all the way through to compliance. I mean, there's no way to solve just one part of that. I would say you really have to make sure that you solve everything on the compliance side, and that it's something that's a delight to use for your end consumers, because that's how, or members in case we're crediting you, because that's how ultimately you're going to make your money back on any sort of tech investment in this capability. So I would just go with the classic school, all of the above.
Cool.
I would agree. It's going to be a slower rollout in 2026. And I think really it's just about adoption. So from our clients' perspective, it's okay. We partnering with Stablecore. We're going to provide the integration points. What's that going to look like? I mean, there's obviously some time in the sandbox that we're going to spend together and making sure that the interface, the APIs are there. And really, I think, Nick, you maybe mentioned this early, but it starts with that one request from that one important commercial customer. So then once there and established, then how do you start spreading the gospel beyond that one customer?
Yeah, well said by both. I feel you won't even get to market without strong compliance and trusted partners. So I think also to lean on what Jason just said, compliance gets you approved, the UX gets you adopted.
Mm. Well said, folks. And I mean, there all these core providers, like you said, Nick. There's press releases that have come out. The stablecoins flexibility is coming. I'd want to be having conversations with them. I'd probably want to be involved in the trials that I'm sure, are ongoing right now, pushing this stuff out. So conversations to be had for sure. It looks like we've had some questions come in from the crowd. So we'll go ahead and start with Chris Wilson's question first for the panelists. Although different use cases just now, in the next 1 to 2 years, do you see a competition with or some kind of integration between stablecoin payments and the FedNow/RTP rails for commercial payments and settlements? Will stablecoin and on-chain payments supplant FedNow and RTP?
I think it's a direct competitor. I mean, I guess we're gonna wait and see. I don't see any integration coming forward. I think, you have to understand where the policy evolution and where stablecoin came from. It was a product of that started with Bitcoin, which was really to circumvent central bank authority. Right? That's the whole. You read Satoshi's 9-page paper. That's it. That's the tenet. It was to make sure that you weren't at the beholden to your federal government's centralized bank. I don't ever see those two marrying one another. Who knows? Never know. Who makes strange bedfellows. But that's just one person's opinion.
Yeah, I think that's right. Stable coins have evolved in the wild and are being used for these use cases. It wasn't planned out or rolled out in the same sense. Maybe one useful distinction is that we see FedNow being much more useful domestically, and stable coins are kind of the international version of FedNow in a certain sense. So that's maybe one clear swim lane or delineation. We also do see that a number of banks, financial institutions are incorporating both in their workflows. So if you're having to set up a relationship with a custodian or a stablecoin issuer, you at times need to be, unless you have a credit arrangement or you have a pre-funded account, you do need to be able to instantly send actual US dollars that reserves in order to make that stablecoin payment. So just sometimes they work symbiotically and are not necessarily working against one another.
Well said. Thanks for the questions, guys. Keep them coming. So moving to the next question. So who owns the liability for a fraud transfer? Someone want to take that?
I would say it depends upon how big and important the customer is to the bank.
I think it probably is. It probably depends on a lot of different things, right? Same principles as like a typical ACH or wire. What role was being played by the provider to step in there and have responsibility? As we said, Genius requires freeze and seize capabilities. So if they're fraudulent transfer, you freeze and seize that. Needs to be able to happen by the issuer. So I would imagine that would be communication between the provider and the issuer to effectuate that freeze and seize.
Right.
Add anything to that? Yeah, go ahead.
Yeah, sorry. I was just going to add, I think it depends a little what you're saying on where the failure actually occurred in the flow, right? Yeah. We can go deeper into that, but I think you all get what we mean there.
Sure. Okay. We got another question from Esteban. On the compliance side, do you expect to integrate into the bank's compliance stack, or are you setting up a new stack for this? Would love to hear the panel's thoughts.
I'll go. I don't think it's an either or. I think it's a hybrid situation. For most fintechs, I think the smartest path, like we talked about, is to integrate into existing bank compliance stacks where possible. They've already got the mature systems for KYC, sanctioning, et cetera. But at the same time, you do need new tooling specifically for on-chain activity, things like blockchain analytics, wallet risk scoring, and transaction tracing. So because that's not something where legacy stacks were built for. So in practice, I think it's about augmenting traditional compliance infrastructure, not replacing it, combining the bank grade controls with crypto native monitoring. I think that's what creates a defensible and scalable setup.
Yeah, I'd agree. And I think, you're looking at tools for that, the large scale fraud platforms, the sardines of the world. This is not built into the neural networks yet. And we all know that, credit card fraud looks different from debit card fraud, which looks different from check fraud. It's just a matter of time before they ingest all the analytics to figure out what the patterning looks like with stablecoin.
I think that's it for the questions from, oh, here we go. Another question from Preeti. Given the irreversible nature of these payments, how does the returns, rejects, disputes managed on these stablecoin rails, which are most acutely managed in traditional rails? Great question.
In DeFi and crypto land, you do not get your money back today. So that's how it's handled today. I'm sure that, given how evolved and at scale, Visa, MasterCard, and the banks have become on dispute resolution, that this is going to be a topic that they take up and maybe agree to something to do on this. But as of the fundamental nature of the technology is, what it is, and you can build something on top of that, but it would be an extra layer, or it might slow things down a little bit. So there might be trade-offs that folks are willing to make in order to have that dispute resolution.
But again, until the focus, the primary use becomes consumer, I don't know that we'll see any sort of reg change on that. But who knows? I mean, at some point, if that's a primary vehicle, then I would imagine there'd be some kind of reg-y parallel, right, where there is a formalized dispute process. But to the next point, there's nothing. It's one and done. And clearly, we haven't seen any sort of regulation on the P2P side either, and Zell's been ripe with fraud. There's been nothing, so it's going to take a lot more volume for any sort of regulatory action to come out.
And I mean, to that point, you can have stuff like this happen with the regular banking system. I've had issues with this on Venmo before. And it's not a problem that's just akin to stablecoins, I guess is my point. Any other questions from the audience before we wrap up here? And really appreciate the panelists' time. Your expert insights have been phenomenal to hear, very relevant for the current environment. Okay, well, I think we can wrap this up, give you guys back a little bit of time for your lunch. Really appreciate the panelists joining me today. I think I'm going to hand it over to the NFO to end it off. And again, really appreciate everyone's time. Thank you for joining us.